Are ETFs and mutual funds just financial twins with different names? Or do they hold key differences that could change how you invest forever? Today, I'm breaking down the battle of the funds, ETFs versus mutual funds. Let's find out which one is right for you. Before we get into comparisons, let's define what each of them is. An ETF, or exchange-traded fund, is a basket of securities you can buy and sell like a stock throughout the day. It tracks an index, sector, commodity, or other assets and trades on an exchange just like any stock. A mutual fund is also a basket of investments, but you buy shares directly from the fund company. And here's a key point: it's priced only once per day, at the end of the trading day. Let's start with what they have in common. Both pool money from multiple investors to buy diversified assets. Both offer diversification, reducing risk by spreading your money across various investments, and both can be actively or passively managed, run by professional fund managers. But here's where the differences begin. Let's explore 7 key areas where ETFs and mutual funds differ. Number 1. Trading flexibility. ETFs can be traded throughout the day just like stocks. Prices fluctuate every second. Mutual funds, only bought or sold once a day after market close. Number 2. Fees and expenses. ETFs often have lower expense ratios, especially passive index ETFs. Mutual funds may charge more, some even have sales loads and management fees. Number 3. Tax efficiency. ETFs use an in-kind exchange process, making them more tax efficient. Mutual funds may distribute capital gains, which you'll owe taxes on, even if you didn't sell. Number 4. Minimum investments. Most ETFs have no minimum, just the cost of one share. Many mutual funds require a minimum investment, sometimes $500 or more. Number 5. Management style. ETFs are often passively managed, tracking an index. Mutual funds are more commonly actively managed. Fund managers try to beat the market, sometimes for higher fees. Number 6. Transparency. ETFs disclose their holdings daily. You always know what's inside. Mutual funds might disclose holdings quarterly, so there's a bit of a lag. Number 7. How you buy and sell. You buy ETFs through a brokerage just like stocks. Easy and flexible. Mutual funds may be purchased directly from the fund company or a broker, often with extra paperwork. So let's recap. ETFs offer flexibility, lower costs, and tax advantages. Mutual funds offer professional management and structure for long-term investors. But which one should you choose? It really depends on your goals, investing style, and how much control you want. If you're a hands-off investor who values simplicity, ETFs may be your go-to. If you want active management, maybe in a retirement account, mutual funds can make sense. Also consider risk tolerance. Both can be risky or conservative. It depends on what they invest in. An S&P 500 ETF is likely more stable than a high-risk mutual fund chasing returns. Remember, even small fees can eat away at long-term returns. A 1% difference in fees over 30 years can cost you thousands of dollars. Use online platforms to compare ETFs and mutual funds side by side. When choosing, look at expense ratios, historical performance, strategy, and risk level. And remember, you can invest in both. Diversifying fund types is totally okay. Pro tip: use ETFs for taxable accounts and mutual funds for retirement plans like 401ks. Let's end with a final side-by-side comparison to make your decision easier. Was this helpful? Like, subscribe, and share if you want more smart money videos like this. Whether you choose ETFs, mutual funds, or both, invest smart and stay financially empowered. Let's take a deeper dive into each comparison category with real examples. Take VOO, a popular ETF tracking the S&P 500, low fees, high transparency, and broad exposure. Now compare it with VFIAX, a mutual fund tracking the same index. Similar holdings, different mechanics. VOO trades during the day, VFIAX does not. VOO usually has slightly lower fees. During market swings, ETFs allow quick moves. Mutual funds are slower to react. ETFs appeal to short-term traders due to intraday trading features. Mutual funds are popular with long-term investors who prefer a set-it-and-forget-it strategy. Let's visualize how a 1% versus 0.05% expense ratio affects your investment over 20 years. A small difference in fees can lead to thousands in lost growth over time. ETFs are easy to buy on apps like Robinhood, Webull, or Fidelity.